In this week's video, we will explore possible investment scenarios for 2015 and beyond, and take a look back at 2014. Some of the bullet points that we'll address in this year-end video. Why did the market model underperform in 2014? Could something similar happen in 2015? If so, can we make adjustments? Maybe more importantly, should we make adjustments? We'll look at a deflationary boom scenario versus an inflationary boom, the impact of Fed policy, our game plan for 2015 and beyond. We'll examine the questions. Is the market model broken? Are the financial markets broken? Are there any positive takeaways from the last 12 months? What about risk management? Is it even worth it? And is buy and hold the way to go? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. In terms of addressing the model's underperformance in 2014, we'll start with an excellent piece from a fellow Yahoo Finance contributor, Dana Lyons. His firm produced this chart here, which is frankly incredible. From 1952 to 2012, there were 38 V-bottoms in the stock market. Think of a V-bottom as a correction that doesn't last very long, and then a sharp V reversal that goes on to make a new high. From 1950 to 2012, there were only 38 V-bottoms. From March of 2013 to December of 2014, there were 10 occurrences. That's incredible. From 1950 to 2012, V-bottoms occurred about once every 1.6 years, meaning if you're building a model, that's an outlier. Recently, we've had a V-bottom occur once every 2.1 months. And you can see they've got the lines drawn here. V-bottoms were relatively rare events that the market model can handle, but V-bottoms back to back to back to back to back to back is very, very difficult for a trend-following model. The purpose of showing this excellent research is not to make excuses, it's just to state the facts, some of the facts as to why we struggled. Is there anything we can do about this if it continues? We'll address that later. Another reason why the market model struggled in 2014 is this chart that we've covered before, so we'll try to move quickly here. But those of you that are new to the fold, this is TLT, or long-term treasuries. In this case, we're looking at risk off relative to risk on. And you can see we've been consolidating since July of 2013. So not only have we had the unusual V-bottoms, but we've also had a confused and low conviction market for the past 17 months. The market model is a conviction model. It looks for pockets of conviction. What does strong conviction look like? Rather than having the ratio move sideways, there's sharp moves or clear trends. You can see in 2008, we had 2 moving average crossovers, meaning 2 changes in the weekly trends. This is high and easily discernible bearish conviction. How many moving average crossovers or trend changes did we see in 2014? The answer is a mind-boggling 9. This is a confused mess here. And again, we're not showing this to make excuses. We'll talk about why we think this is happening and what we can do about it. We'll examine 2 main reasons for the confusion and indecisiveness. The first one is interest rates. The point of what we're showing here is pretty simple. In 2003, the expectation that the Fed was going to raise rates started to pick up, similar to what we've seen in the last 2 years. And in 2004 and 2005, the Fed began hiking interest rates. In this instance, we're looking at risk on versus risk off, or stocks versus bonds, economic confidence versus economic fear, low systemic risk versus high systemic risk in terms of fears, SPY, the S&P 500 divided by AGG on a weekly time frame. What are the takeaways here? ADX, this black line down here, measures the strength of a trend. It doesn't tell us whether the trend is bullish or bearish. It just tells us whether it is strong or indecisive. When the ratio of stocks to bonds plummets like this, it tells us that we have a strong bearish trend or strong bearish conviction. Notice from 2007 through the end of 2011, ADX was higher here. This profile is different. It's 2004, 2005, 2006. The Fed is raising interest rates in this period here, and we have very, very low conviction and indecisiveness, which makes sense. Investors can't decide whether the economy is strong enough to withstand the interest rate hikes from the Fed, or the economy is going to roll over and I'd prefer to own bonds. In the present day, we have moved back to a very, very low conviction market. Notice we're in the red box here in 2014, a similar low conviction period to what we saw when the Fed was raising rates. The exact same chart, we're just looking at SPY relative to TLT this time. This is the period where the market model will struggle. ADX is low, there's no trend, and ADX is trending sideways at low levels. With the Fed talking about raising interest rates sometime in the next 12 to 24 months, this could continue. If it does continue, and we have a trendless market, a low conviction market in 2015, is there anything that we can do? Before we started our due diligence in terms of trying to answer that question, we knew the answer was yes. This is your low conviction period, the S&P 500 back in 2004 and 2005, when the Fed is raising interest rates and talking about raising interest rates, similar to where we are today. This is the base model for the S&P 500. This is the market model. These are the moving averages. You can see, much like 2014, it's a whipsaw machine. It's very, very difficult when the market is confused. So again, what can we do? One of the ways that we can possibly handle that is to use longer term moving averages. This is the exact same chart here with moving averages that allow the market to swing more. So volatility to ignore has a much, much lower threshold here than it does here. If the trend is up, but we're getting indecisiveness, you have to let your portfolio swing a little bit more in order to stay with the trend. So the answer to the question is there anything we can do? The answer is yes, but later we need to look at, does it make sense to do it from a risk-reward perspective? We can port those exact same concepts from a weekly chart. This is a weekly chart, the current model, to a monthly chart. So these moving averages, conceptually, we're using this for illustrative purposes, would also help you stay with the trend. You don't get nearly as many moving average crossovers or whipsaws during the same period when the market is indecisive. While we're talking about longer term concepts, we do not want to lose sight of the present day market and our risk management duties. We've seen this before. This is weekly 2008. This is what risk off looks like. This is what risk on looks like. This is the S&P 500 as of the close on Friday, January 2nd. You can see once again we're getting a more vulnerable look with price below blue and red, and the slopes of blue and red are down. So we have to go into next week with an open mind about protecting principal. This is the present day market. Now we're looking at the alternative moving averages to help eliminate whipsaws. This is weekly. You can see some vulnerability here. This still looks good, but when you come down like this can easily roll over if price continues to be weak. We have to keep an eye even on this time frame. The monthly looks a little bit better, but we've got price close here. And once again, if weakness persists, this chart could go from a favorable look to an unfavorable look fairly quickly. Would the threat of the Fed raising interest rates alone be enough to cause these abnormal market behaviors, such as the V bottoms that we've seen and that trendless TLT versus SPY chart? The answer is probably no. So let's look at the answer from a part 2 perspective. If you've been close to the markets during this period here, you know that in an inflationary boom, leverage tends to increase from an investment perspective, margin and balance sheets. We get a weaker US dollar. When the market rallied off a low during these periods, especially closer to 2011, from 2000 to 2011, a rally often was led by weak dollar assets such as emerging markets, precious metals, energy, and small caps. During an inflationary boom, there's a fear of inflation, which typically causes bonds to lag stocks. And our stock-bond ratio tends to be more binary. When I'm confident, I'd rather be in stocks for these reasons. When I'm not confident, we shift to more of a traditional deflationary look. If you invest in multiple asset classes or a broad base of ETFs, you know that this has not been happening really since 2011. So instead of being in an inflationary boom, it's possible that we're in a deflationary boom, where deleveraging is still taking place. Rather than the dollar being weak, it's been strong. Your market leaders look different, and your market laggards look different. Instead of a fear of inflation, we have a fear of deflation. Thus, we have a higher demand for bonds even during the bullish phase in the stock market. As a result, the stock-bond ratio is much less binary than it was here. Risk on here is a confident risk on. Risk on here is much, much less confident. If we're in a deflationary boom, which is just a possibility, but we are seeing these type of characteristics, we have to acknowledge that change is not uncommon. There are secular shifts all the time in the markets. They just take place over longer periods of time. Therefore, the stock market is not broken, and the market model is not broken. The market model did exactly what it was designed to do this year. We just had a more difficult year, and we may be operating under a different backdrop. The good news is, under all scenarios, whether you're in a deflationary boom or an inflationary boom, risk off or a bear market pretty much looks the same. It's a deflationary event, and people will migrate to the safest of safe, longer maturity bonds. If this is true, and with the knowledge that the Fed may raise rates and that makes it more difficult for the market model, can we adjust? These 3 bullet points are the areas where we can adjust. The ETF scoring model looks at the dollar, it looks at bonds, it looks at commodities, and it can't tell the difference between a stock ETF, a bond ETF, and a currency ETF. In this environment where the dollar has been trending, bonds have been trending, we can treat TLT, long-term treasuries, intermediate-term treasuries, IEF, and UUP, the U.S. Dollar Index Fund, as hybrid assets. They can be considered growth assets as long as they're trending, and conservative assets during risk-off periods. There are some benefits to doing that. It can lead to fewer transactions, fewer whipsaws, and it allows us to carry conservative-oriented growth assets that can also act as an equity hedge, because these will still typically do well during risk-off periods, and they'll allow us to offset some of the risk in our stock-oriented ETFs. If we look at a chart, it's easy to understand the rationale. This chart is from the ETF scoring model, and it's one of the charts that we use to narrow down and choose ETFs for both the conservative and growth side of the portfolio. Let's assume for conversation's sake that this is not TLT versus SPY. Let's assume that it's a stock ETF relative to a stock ETF. So assume for the moment that TLT is a stock ETF. If TLT and SPY were both trending and scoring well, and we were trying to discern between the two, when we looked at this chart, we would basically say we'd be willing to own both of these stock-oriented ETFs as long as they're leaders. Well, if that's true for a stock-oriented ETF, it should be true for a bond-oriented ETF as well, as long as TLT can clear the mathematical hurdles that are required. If it can't, then you cannot treat it as a hybrid asset. The same goes for IEF, the same goes for UUP. This is the weekly chart of the NYSE composite that we've shown on short takes before. One other point here, the look of this chart is telling us that to capture the returns in the stock market this year, you had to take higher risk than you typically would. This is a much, much lower risk reward proposition here when conviction is much more clear than it's been in the past few months. Early in 2014, we saw some of those V bottoms that made it difficult, and we had a drop and a V bottom right out of the gate, and then a W formation. These are V bottoms that Dana wrote about. And then after that, the problem for the model was different in the second half of the year. It became indecisiveness. There were 9 moving average crossovers in calendar year 2014. Compare that to a much, much more typical or easier period in 2009, where there were only 4 in a 12-month period. Here, there are 7 in the second half of the year. 2013, you can see we have a clear uptrend, much more conviction, and only 5 moving average crossovers in the 12-month period. This is a high bearish conviction period. The model can see it with only 2 moving average crossovers in the 12-month period. A confused market isn't necessarily a bad thing for the model. What's difficult is when it's confused and whipsaws in short periods of time. In 1998, we went up, we went down, we went up. But the trends were clear, and it's much, much easier to discern. You can scale in here, scale out, scale in again. Very, very difficult for us to do it on our time frame here. Now we're moving to the research and due diligence portion here. This is the base market model chart here. This is the market model versus SPY. This is the low conviction version where we've stretched out some of the time frames. We want to make sure that we can still manage risk. The answer is, for the most part, yes. This is a hybrid version of both of them. So before we can stretch them out, we want to make sure that we can balance risk and reward. This is a good way to think of what we're looking at here. The base model plus the low conviction model equals the blended hybrid model. Also note that underperforming the market is not necessarily surprising. It can happen. This is relatively large underperformance here, but overall the performance is still good. It's impossible to build a model that's going to work under all market conditions. What you want and what the purpose of the model is, we're trying to beat the market over a full cycle. So a bull market in blue here, a bear market in blue here, and a bull market here. The objective is not to beat SPY every year. It's to beat substantially over a full market cycle. So addressing our questions, is there something we can do? Yes. Should we do it? Yes and no, under specific circumstances. Therefore, how would we use this, and how do we plan to use this in 2015, 2016, etc.? A good way to visualize what the market model does for us is to think about the antique car ride at the amusement park. It allows the kids to drive the car, but there's a metal rail in the middle of the track to make sure that they don't go off the road. So in terms of how we would use the base model and the low conviction model, there are two reference points that we have. So instead of having one rail, under certain specific circumstances, we have a second rail or a second reference point to make sure that we don't go off track for long periods of time, or in terms of magnitude. If we can use the rails and we can avoid making big mistakes or making mistakes for long periods of time, you have a good opportunity from a probabilistic perspective to leverage the miracle of compounding over the full cycle. If we are indeed in a deflationary boom, and that's yet to be determined, it's quite a bit different from an inflationary boom. This is somewhat of the cycle of how a bull market shifts to a bear market. This is what we've all lived through. The transition from a bull to a bear in a deflationary boom may be quite a bit different. A deflationary boom usually takes place after an inflationary boom. We just had one where deleveraging is taking place. You get slower growth, and as a result, the Fed keeps interest rates low for a long period of time. The stock market tends to do well in this environment for different reasons than it does in this environment. For the most part, a lot of the money that's going into the stock market has been forced into the stock market because it's very, very difficult to make money in CDs or bonds in this environment. Even though some people own stocks, they still are very, very leery about economic conditions. During a deflationary boom, there's a relatively large subset of investors that are in stocks that believe the Fed created all of this, and they don't trust the stock market, they don't trust the economy, and they don't trust the system. In an inflationary boom, typically, the economy begins to contract, and then we have a bear market. In this world, it may be quite a bit different. We could get to a point where money is being forced into the stock market, and at some point, valuations relative to slow growth become a problem. The stock market drops, and that impacts the economy and drags it into a recession, and hence we end up in a bear market. In this scenario, it could actually be the financial markets that kick off the next recession. That's a little bit different than the world we all grew up in. Before we cover possible investment scenarios, it's important to understand in an inflationary boom, stocks and weak dollar assets tend to do well. It's quite a bit different than what happens during a deflationary boom. As always, it's extremely important to keep an open mind about where we go next. Let's look at some scenarios here. If we assume we're in a deflationary boom, basically one of two things can happen from here. One path is that economic growth picks up and inflation picks up, and we morph into a more traditional inflationary boom. When inflation starts to become a problem, the Fed is forced to raise interest rates, and eventually you get an economic contraction and a bear market. Under this path, eventually bonds win. If we go from a deflationary boom to a point where valuations relative to slow growth become a problem, or the fear of interest rate hikes from the Fed cause the market to drop, that in turn could drag down the economy even further, and we could move into the deflationary bust cycle. Circling back to the is the market broken question, no, the market's not broken. The indecisiveness makes perfect sense. Why? If we head in this direction, there's high risk in bonds. If inflation picks up and interest rates go up, bonds could get killed. If we move in this direction, there could be very high risk in stocks because the market could drop rapidly and it could be the market that kicks off the next recession. So rather than being broken, the stock market and bond market are acting fairly rationally at this point. The same is true for the market model. The market model is not broken. We have a very low conviction whipsaw period, which is difficult for the market model. If you showed me those charts before the year started and said, how will the model do? I would have said the model will struggle mightily under these conditions. Now, that doesn't mean that we shouldn't have done our due diligence and looked for some adjustments in case this continues. And we've done that as we head into 2015. Now we'll examine the questions, is buy and hold the way to go? And should we even bother with risk management? This is a period here where buy and hold worked very well. These gains here were quickly put into perspective when the S&P 500, or SPY in this case, fell over 50%. Buy and hold works until it doesn't. The answer to the question, is buy and hold better than risk management? That's personal preference. But take this into consideration. This 56% loss in SPY brought SPY back to a level, the same level that it was at in 1997, which means 10 years of stock market gains were wiped out in the bear market. You may say, Chris, you always show us these charts, but these are very specific circumstances. History says otherwise. In the 70s, the Dow plunged almost 27%. The early 1960s also saw a 27% loss in stocks. This decline that began in 1968 didn't stop until portfolios had lost almost 36% of their value. This decline in the Dow hit the 45% mark before stocks reversed. In the 1930s, we almost hit the 50% barrier. And the granddaddy of them all, a decline that started in April 1931 didn't stop until the Dow lost almost 90% of its value. How about bonds? This table from the Triumph of the Optimist via Investopedia shows the largest declines historically across the globe in the bond market. The average loss in the table, 35%. The median loss in bonds, 32%. We showed earlier a period where SPY lost 56%. If we started with $1 million, lost 56%, or 561,000, we'd have 438,000 left. We would need to make 128% from this point here just to get back to break even. We understand and respect that this is a performance-oriented business, and we have not lost sight of that. However, we should look at 2014. There are some positive takeaways for us. We followed the rules during the entire year. We stuck to our highly disciplined system. We managed risk. If you're a client, you know we managed risk by reducing exposure to stocks during the October low. We identified shifts in market behavior. We acknowledged the need for some adjustments. We conducted significant amounts of research behind the scenes over the past few weeks, performing our due diligence, and found some acceptable risk-reward solutions. As we've noted in videos in the past, when things are going well when you use a system, you should stick to your discipline. When things are not going particularly well, you should stick to your discipline. As we head into 2015, I'm very confident that if we stick to these 2 bullet points, that good things will happen. Obviously, making money is also a very, very important part of the equation. This is the S&P 500 again as of January 5th. The model reduced risk here, and we scaled back in. The jury is still out on whether or not this worked. Why? Well, we still have this inverse head and shoulders pattern, and as we've shown in past videos, if we break this neckline, we could get a very, very strong move in this direction. If the bears win out and we go into a bear market, the model can begin to add value on the principal protection side of the equation. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currency, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.